What is up, guys? This is Matt Cox back with another episode of the Saucetown Investor. This will be my final episode recorded from Oregon on this trip. I'm flying back to New York on a red eye this evening. By the time you hear this, I will be back in the big city. So today we are going to talk about the biggest wealth unlock in real estate that no one talks about. There's actually 4 ways to get wealthy from real estate. 2 of them everyone talks about. One of them is appreciation, the value of your property going up. Second is cash flow. We all know what that means. When your rents are more than what your expenses are, that is your cash flow. Rents are $1,500, expenses are $1,300. I made $200 in cash flow that month. The third one is your loan pay down. That's just your every time you make a mortgage payment. If you have a mortgage, your loan balance is going down. But we're going to talk about the 4th one today, and that is depreciation. So unless you've been under a rock since 2016, you've likely heard a bit about the tax trials and tribulations of a certain former and current president, Donald Trump. And as you know, before he became president, he was a pretty big time real estate investor in New York, even if he maybe embellished the value of his holdings a little bit, which back to those tax problems, he was a big time investor and continues to be. As far as his taxes go, he famously didn't release them in 2016 before the election for kind of obvious reasons now, as he was ordered to pay about $450 million in damages to the state of New York related to some financial crimes there. But aside from that, all of this stuff that's maybe some of it illegal, some of it kind of gray area, there's one part of the tax code that he has used masterfully, and it's completely legal, and you guys can use it as well, whether you own a single family rental home or you own a 100-unit tower in downtown Manhattan. Everybody has access to it. This is the part where I hop in and preface this with, you need to talk to an accountant. Matt is not an accountant. If you listen to my advice and have the IRS show up at your door, that's your fault. Okay. So talk to an accountant. I'm going to give you the outlines of how this works, but get a professional. Okay. Enough of that. So as I mentioned, Trump's stuff ranged from illegal to completely legal in the case of depreciation. The IRS defines depreciation as, quote, an annual income tax deduction that allows you to recover the cost or other basis of certain property over the time you use the property. So we talk about real estate here, but this can apply across the business world. I have a buddy who's a farmer. He depreciates the cost of his tractor or farm equipment over time. If you're a grocery store or restaurant owner, you can depreciate your fancy oven that you bought. I mean, this stuff applies everywhere, but it's particularly valuable in real estate. Okay. So, in the context of real estate, you probably see a lot of gurus online talk about cutting your expenses, not just in real estate, but just in personal finance. So, I mean, the ones that are usually mentioned are housing and transportation, right? If you got an expensive car, you got an expensive rent or mortgage payment. But in most cases, your number one expense is actually your taxes. And that's what's so valuable about depreciation, is it can take a chunk out of that tax bill. I mean, we've all heard one of the oldest phrases in finance, and it's overused, but it's completely true, is it's not what you make, it's what you keep. If you make $10 million this year and 9.9 of it goes to the IRS, who cares that you made $10 million? That's, of course, an extreme example, but you get my point. Depending on what state you work in, what jurisdiction, you may have as much as 50% of your income going to taxes if you're a W-2 worker. I mean, most of my listeners are in New York and Oregon. Okay. Those are very, very high tax states. And if you're making good money as a W-2, you're probably up close to that 50%, maybe not quite, but you get the point. So I'm going to give you guys an example of how this actually works. Okay, I'm sure you've probably heard it before. Real estate investors don't have to pay taxes, and there is some truth to it. So I'm going to give you a real life example of how this could potentially play out. Okay, so stay with me. So let's say Matt buys an 8-plex in Salem for $1 million. This is actually similar to I don't have the exact numbers, but this is going to be kind of a deal that I did. Hey guys, we're taking a quick break, but before we get back into it, if you're enjoying this episode, make sure to like, share, and subscribe. It really helps us to keep bringing you more valuable content. And if you're on Apple Podcasts or Spotify, don't forget to leave a review. Please, it makes a huge difference. All right, let's get back to it. Okay, so what we do is we buy it for $1 million. We decide that the building is worth $800,000 and the land is worth $200,000. We got our $1 million right there. And there's different ways to value what the building is worth versus what the land is worth. And you can talk to your accountant about that. Sometimes you can go 90-10, sometimes it's 70-30, but for this example, we're going to go 80-20. And the reason we have to do this is because the building can be depreciated because a building has wear and tear. I mean, the idea is that the whole point of depreciation is that you have an asset that you're having to pour money into over time, and it is depreciating. Okay. If I spent 25 grand on a new roof 20 years ago, today that roof isn't worth 25 grand. It's depreciated. So it's a way of valuing what you're having to put, the money you're having to put into the building over the course of years. Now, the land doesn't depreciate. Land is land unless, a meteor hits it or something, but I don't think the IRS has contemplated that scenario. So back to the numbers. Buy the house for $1 million. We've decided the land is worth $200,000. The building is worth $800,000. So let's go over the course of the year. The building nets $25,000 in cash flows from rents after all repairs, mortgage interest, taxes, insurance, and any other costs are paid. Okay, we're left with 25 grand left over, right? So, okay, if you're a W-2, it's okay, time to pay the IRS. They're probably taking close to half of that 25 grand that you netted. But in residential real estate, and a note here, it has to be an investment property. You can't do this with your personal residence. It's got to be a business property. The property gets depreciated over 27 and a half years. Okay. $1 million property, buildings worth 800,000, land's worth 200,000. It makes 25 grand in cash flows this year. So what does this actually mean if we're depreciating it over 27 and a half years? The idea, again, is that the building will depreciate, need roof, siding, upkeep, whatever. The simple way to think about it is that it's wear and tear over the course of time that makes the building less valuable unless you fix it. Okay, so here's how the numbers play out. Remember above, we determined that our building was $800K. That value decreases, at least as far as the IRS is concerned. And that's the cool thing about this, is in real life, the market value usually goes up. But as far as the IRS is concerned, the value goes down. That's what you want. That's the sweet spot right there. That's what makes real estate so cool. So we take that 800 grand value of the building, we divide it by 27 and a half year depreciation schedule. And we end up with 800,000 divided by 27 and a half equals $29,090. So that number, 29,090, is now a tax write-off. Okay, if your head's spinning a little bit here, I'll bring this all together. Okay, so back above, remember, our 8-plex produced $25,000 in net income this year. If that was W-2, we would just pay the IRS, pay Uncle Sam, pay the state, and that's just how it goes. Instead, we use that $29,000, little over $29,000 tax write-off that was granted to us through depreciation. So instead of having $25 grand of taxable income, we now actually show, as far as taxes are concerned, show a loss of $4,000. So that's right. We made a net of $25,000 in our pocket. And instead of paying the IRS is actually going to owe us money because we show a loss of 4 grand. As the great Michael Scott would say, how the turntables. So again, the W-2 worker might keep half of this. Instead, we're getting money back from the IRS. And it's weird to think about this, but your income in some cases literally might be worth twice as much if it's produced through that eightplex as opposed to if it's produced through your day job. So, I mean, simple way to put it, you make 100 grand through real estate, it can be the same as making 200 grand at your W-2. And the cool thing about this, you get up into bigger numbers. We talked about Trump or any big developer. You move these numbers, you can go 10x. You know, this was $1 million property. You make that a $10 million property, $100 million property, whatever. All this stuff still applies, and you sprinkle in, a few decades of compound interest and not having to pay taxes on it. The results are insane. So we're going to talk about a lot of strategies on here, and there's all kinds of gurus on Instagram and stuff that'll be throwing different ideas at you. And a lot of them are good. I'm not going to lie. But it might be today it's wholesale, tomorrow it's house flips, the next day it's sub 2. There's a lot of ways to win in this game, but sometimes the simplest way is the best one. This is the biggest hack in real estate, and it's been around in the US since the 1830s. It's literally buy and hold a rental property, produce cash flow each month, pay no taxes on the cash flow, watch the value of the property go up over time while you pay down your mortgage, rinse, repeat. It's not rocket science, but it takes time, it takes patience. There's a lot of get rich strategies out there. This isn't one of them, but man, like I said at the beginning, your taxes are your biggest expense. In most cases, more than your house or anything else. If you can cut into that expense or eliminate it, that is a game changer. So I hope you guys got something out of this one. If you have questions, like I said, talk to an accountant first and foremost if you want to use this. But if you have general questions about it, feel free to DM me. So this has been another episode of the Saucetown Investor, and I hope I helped you to not pay any taxes in 2025. That is a wrap for today's episode. Thanks for tuning in to the Saucetown Investor. If you got value from this, drop us a comment and let us know your thoughts. Did you have a big takeaway? Is there a topic you want to see us cover next time? Is there a guest you want to see interviewed? DMs are open. Business is at Saucetown Properties, and my personal, you can DM me personally, is at the Real Matt Cox 4. We'd also like to ask you kindly to please like and subscribe. You can also follow along with the Saucetown Investor blog. That's mattcox444.substack.com. Thanks again, guys, and until next time, keep investing and stay saucy, Saucetown.